Imagine a world without a common language. Chaos, right? That's what it would be like. In the financial world without standards, businesses need a way to talk to each other no matter where they are. That's where accounting standards come in. They're the common language of business. Two big players in this world are IFRS and GAAP. IFRS stands for International Financial Reporting Standards. GAAP stands for Generally Accepted Accounting Principles. These standards are the rule books for how companies record and report their finances. Think of them like referees, making sure everyone is playing by the rules. It's about keeping things fair and transparent. When everyone is on the same page, investors can make informed decisions, businesses can grow with confidence, and the global economy hums along. But here's the kicker. IFRS and GAAP aren't exactly the same. They have different approaches, like two referees with slightly different styles. This can make things tricky for multinational companies operating in different parts of the world. So what's the difference between IFRS and GAAP? Imagine them as two chefs making the same dish. They both want a delicious result, but their methods vary. IFRS is like a chef who prefers flexibility and judgment, trusting their instincts in the kitchen. They focus on the spirit of the rules, allowing for different interpretations based on the situation. This is known as a principles-based approach. GAAP, on the other hand, is like a chef who sticks to a strict recipe, measuring every ingredient precisely. They follow a detailed set of rules and guidelines, leaving little room for interpretation. This is called a rules-based approach. For example, let's talk about inventory, those beans, croissants, or gadgets a company has ready to sell. IFRS allows for more wiggle room in how companies value their inventory, considering factors like market conditions. GAAP is stricter, generally requiring companies to value inventory at the lower of its cost, or its market value. These differences might seem minor, but they can significantly impact a company's financial statements. That's why understanding the nuances of both IFRS and GAAP is crucial for anyone involved in the financial world. Let's take Starbucks as an example. The coffee giant operates in over 80 markets worldwide, each with its own accounting standards. In the United States, Starbucks follows GAAP. This makes sense since its headquarters are in the US and it reports its consolidated financial statements there. But what about its international operations? Things get interesting here. Starbucks uses a method called the functional currency approach. This means they determine the most relevant currency for each of their international subsidiaries based on factors like where they generate revenue and incur expenses. They then translate those foreign currency transactions into US dollars for their consolidated financial statements. This might sound complicated, but it's all part of navigating the complex world of international accounting. Starbucks needs to ensure its financial reporting is accurate, transparent, and comparable, regardless of where it does business. The need for accounting standards isn't new. Way back in the 15th century, a Franciscan friar named Luca Pacioli revolutionized accounting with his groundbreaking book, Summa de Arithmetica, Geometria, Proportioni et Proporzionalità. This book introduced the concept of double-entry bookkeeping, a system still used today. Pacioli's work was a game changer. It provided a standardized way to record financial transactions, making it easier for businesses to track their income, expenses, and overall financial health. This innovation paved the way for modern accounting practices and the development of standards like IFRS and GAAP. Fast forward to today, and the world of accounting is more complex than ever. Global trade, intricate financial instruments, and the rise of digital currencies have created new challenges and opportunities. As the business world evolves, so too will the accounting standards that underpin it. Understanding these standards is key to navigating the global marketplace and ensuring a stable and prosperous financial future. Thank you very much for watching the video. Like and subscribe the channel for more videos of accounting.